Is the labor market starting to crack? What does the recent jobs report released yesterday say about the current state of the labor market and the good news for the average American worker? We had non-farm payrolls data yesterday. This is a monthly jobs report put out by the Bureau of Labor and Statistics. And here we see that non-farm payrolls number. We can see it came in at 139,000. The estimate was 125,000. So it actually came in hotter than expected. The other piece of context, though, is that it comes in an overall trend over the past 5 years of a cooling labor market. This is something Jerome Powell has noted many times as well, that the labor market had gotten to kind of stretched historical levels from a historical basis. And what we have been seeing is a moderating in the labor market, but that is just a return to a much more historical average. And this is a baseline chart. So anytime it dips orange, that means payrolls are being subtracted. Anytime it is white, that shows payrolls being added. Again, there's the past 5 years, the labor market has been cooling, but still remains positive. And you can see kind of in the broader historical context, this chart goes back to the 90s. You can see that the level that we are currently in is well within the historical average. Some good news, though, is that the average hourly earnings beat expectations, came in higher than expected. So you can see average hourly wages, this came in at 0.4% when the expectation was 0.3. We can see that hourly wages year over year, this is a month over month number. You can see hourly wages year over year came in at 3.9%. The expectation was 3.7%. I just want to point out one note of caution. If you hear people annualizing this hourly wage, this month over month hourly wage gain, if you hear people extrapolating this 0.4 out to an annual number, I would say be very skeptical. That's, yeah, I would just say be very skeptical of that. Here we see one of the components of overall payrolls. This is one of the subcomponents of overall aggregate payrolls. This is government payrolls. And in blue, we can see the total government employees. And then in the baseline chart here, we can see the number month over month of government payrolls created. We can see that this actually came in negative, not by a lot, only by 1,000. But this came in negative for the first time since 22. But overall, the total government employees is well above its pre-2020 level of about 23.8 million. It is leveling off for sure, and many people are aware of what has been kind of going on with government payrolls in particular, with the current administration. But I think that this will be something to keep an eye on if this returns. If the government jobs market starts to shrink even further, and this number starts to come down, generally speaking, you can see that doesn't generally happen. The government kind of grows and grows and grows. It somewhat normalized due to the events of 2020, but then we can see it's rebounded and well above its prior 2020 level. Here's continuing jobless claims and initial jobless claims. This is just what it sounds like. Initial jobless claims, we could see 247,000 people filed for initial jobless claims. The continuing claims is ticking up, though, and currently about 1.9 million are filing for continuing jobless claims for unemployment. And we can see that number bottomed in May of 2022. So here's the unemployment rate. And what we see here in the white number, this is the overall unemployment rate. This is what you will hear reported on the news. This is that aggregate overall unemployment rate. This one is non-seasonally adjusted. But then I also added a couple components. So I put the unemployment rate by age. Red is 16 to 19-year-old unemployment rate. 25 to 54 is in purple. And then this U6 unemployment rate. This is not talked about very often, but this is unemployed, discouraged workers, and part-time for economic reasons. This is a much more broad measure of unemployment. And two things I think that are notable: clearly, unemployment in the aggregate bottomed in summer of 2022 and has been headed higher ever since. Generally speaking, you don't see it start to head higher like that, set a bottom, start to head higher, and not go nonlinear in a recession. So the recessions here are shaded in red. And generally speaking, unemployment goes nonlinear in a recession. And like I said, generally speaking, you don't see it bottom, start headed higher, and not end up going nonlinear. And so, maybe this time is different. I do also think it's notable that 13%, the bottom for the unemployment rate for young people for 16 to 19 was about nine and a half, and is currently 13 and a half. So this unemployment rate plus the U6. So U6 is, like I said, not talked about very often, but this is a much, in my opinion, better measure of actual unemployment. You can see that unemployment here in the aggregate, the headline number that gets reported, is still well below kind of historical norms, even during good times. This overall unemployment number that gets reported is very low. This chart goes back all the way to the 70s, and you can see that even where we are now, still is a very strong unemployment number. But once you start to look at U6 or certain components of this unemployment, the picture doesn't change drastically, but it does change notably. We can see that the unemployment rate here, this U6 rate, unfortunately, the data only goes back to the mid 90s, but this is higher than we saw, and the same is true for this youth unemployment rate, which we can see. Generally speaking, the unemployment rate has been kind of headed down, going back to the 70s. And so these are some components of that unemployment rate. Here's job offers and job quits. This is just what it sounds: job offers, job openings versus job quits. We can see 3 million people quit, 7 million open jobs. But what I wanted to point out was this. So this is the job quits divided by the job openings. So remember, with the relative chart, the way this works, if the numerator is growing faster than the denominator, this line will go up. If the numerator's falling, if the denominator is growing faster than the numerator, this line will fall. So what this indicates, I think, is in line with some of the other data we just looked at, which is this bottomed in April of 22, and so the fact that quits have been rising faster than job openings, this is actually a sign of a somewhat healthy labor market. The fact that more and more people are quitting versus the job openings. But again, in the overall historical context over the past 20, 25 years, we can see that job openings has been growing faster than the quit rate. Here are some subcomponents of those job openings. We have information, total private overall, and then in blue, manufacturing. Manufacturing fell. Meanwhile, job openings for information rose pretty dramatically. And I know a lot of people have heard about the issues in, say with tech workers. That's being discussed much more often, and clearly there's some automation going on with AI. But I think that this rise in job openings for the information industry is interesting. So here is employment levels by industry. So I was just going to go through this real quick. We can see the total private. We can see mining and logging, which has been in a pretty significant downtrend. We can see construction, which I think this is important. This can sometimes be used as a barometer. You can see here prior to '08, this construction employment started to fall off, almost predicting the 2008 GFC. Here's manufacturing. We have covered this particular component at length here. We can see that it has also been in a downtrend. This downtrend is way worse when you look at it in the larger historical context. This only goes back to 2005, but we can see manufacturing is down from its peak in 2022. You can see wholesale trade, say retail trade, which this has remained relatively flat for a while now, for many years now. Transportation and warehousing, utilities, which showed strong growth. Information here, we see that weakness in the information field. This is the employment level, and over here is per thousand. So 9,000 is 9 million. Here's financial activities. We can see, given the financialization of our economy, this is one of the areas that remains strong. As does professional and business services. This is kind of those high-end services like consulting and that kind of thing. You can see private education and health services, leisure and hospitality. Unfortunately, this line is kind of hard to see, but this is right around its pre-2020 peak. And other services, government. So this is overall government. This is total government. This is what we were looking at before. Here breaks it down by, here's the federal government. We can see that this number dropped from a peak of about 3 million down to 2 million, 2.95 million. Here's state government, which also has remained very, very strong. And here's local government. So local government and state government, when you look at government spending as a share of GDP, federal spending as a share of GDP is about 25%. But when you look at total state and local government, right, you look at the entire government, not just federal, but state and local added in there as a share of GDP, it's actually about a third. So about 33, 34% once you start to add in the state and local government. Here is average hourly earnings on a month-over-month basis. This is what we were talking about the beating estimates, right? The estimate here was 0.3% month-over-month gain. Average hourly earnings on a year-over-year basis in red. That also beat. The expectation was 3.7%, came in at 3.9%. And then in blue is the average hours worked. So this is another kind of under-discussed metric when it comes to the labor market. A job is not necessarily all that great, and this goes to the U6 point that we were talking about. A job is great, but if you're being forced to work, say, 20 hours, when really you would like to be working full time, 35, 40 hours, well, that job, even though it was created, that job doesn't necessarily give you the same amount, the average American, give them the same amount of strength, right? They are not necessarily in a much better position just because a job was added if they are not able to work full time. And again, we can see that this peaked in March of 2021, April 2021, and has been declining. So at its peak here, the average hours worked was 35 hours per week, and that has dropped to 34 hours per week. We can see this wage growth, which has been, I will take off the hours worked, hopefully clean it up. There we go. So we can see that this average hourly earnings, this is again a year over year number. As inflation has been moderating, right? We've talked about the peak in inflation following 2020. As we have been in this secular trend of disinflation, at least over the past 5 years, the average hourly earnings growth, right? This is a growth rate, has also been following a similar trend. Although, if you'll remember, the CPI on a year-over-year basis actually set a new low. It's just about a quarter or 2 quarters worth of data. But if you look at, I will show it here. If you look at the inflation rate, this actually broke and made a new low, whereas the hourly earnings on a year-over-year basis set a higher low. Again, it's only about a quarter's worth of data. But if we can see a situation where the average American, the average hourly earnings are growing faster than inflation, that is great. I mean, currently we have inflation, at least calculated by CPI, at 2.3%. Meanwhile, this average hourly earnings on a year-over-year basis is growing at 3.9%. So now, the headlines and the news and what you hear is that this is real wage gains. Uh, you know, uh, that is true, according to the way the government calculates real wage gains. But I think most people know that the CPI number, this purple line, this inflation rate that they use to calculate real wage gains. This purple line, the inflation rate right at its peak was about 9% CPI. If you talk to the people I've talked to in real life, the real average workers in America, said that inflation was much closer to 18, 19, 20% by their estimate. And if you calculated inflation by the way that it used to be calculated, I think CPI did hit a peak of either 18 or 19%, which means that the government metric could be undercounting by a huge degree. And I did a whole video on that if you're interested. So I thought something that was interesting here is the largest gain was Santa Clara County. So this had the largest year-over-year percentage increase in the weekly wage. It grew 15%. Within Santa Clara, an average weekly wage gain of $784. That's $784 per week, representing a 13.7% increase. And this was in the professional and business services. So that happened to be the highest. The largest decrease came in Lake, Illinois, with an average weekly wage loss of $537, and that was in trade, transportation, and utilities. So if you are listening from Lake, Illinois, does not sound like things are going very well over there. I don't know what's happening, but all the best wishes. So here is employment and average hourly earnings by industry. This is the most recent data as of May 2025. This is seasonally adjusted. So the way this chart works, anything to the right of this vertical black line here means that jobs that are being created. Anything, and then this dotted horizontal line, that shows the average hourly wage. Currently in America, the average hourly wage is about $36.20. So any of these bubbles above that dotted line indicate that the wages for that industry are higher than the average. We can see that, for example, leisure and hospitality, I mentioned this a lot, with the services element of the American economy, the labor market, is a relatively low paying job, but we seem to be adding a huge amount of these jobs. So you can see it's well below the national average of $36. Currently, it's $22. That is well below the national average, but we are adding, and this has been true for years and years and years. We have been adding huge amounts of these low-paying jobs. So here's private education and health services. That is right in line with the average hourly earnings. And we can see that that sector has remained strong as well. Here is retail trade, which again is a very low-paying services industry. And we can see that is also well below the national average of $36. This is $25. And this actually saw some contraction month over month. Here is transportation and warehousing. Here is other services. Here's manufacturing. This is right in line with the national average. Did see some contraction. We saw that in the other chart that we were looking at here. Now, whether or not this changes is really the the metric to watch. But manufacturing peaked back in 2021. We can see construction here again showed some growth. This is usually a positive cyclical sign when construction is very cyclical. And generally speaking, when construction jobs are being added, that's a positive sign from an economic cycle, from a business cycle. Here up top, information, $52 per hour, well above the national average, and showed just a very slight amount of wage gains. Utilities, also very high paying, $51.90 per hour, well above the national average. Also added some jobs. Here we see financial activities. So again, this hyper financialization of the economy is great if you work in banking, if you work on Wall Street, fire, finance, investment, and real estate, finance, insurance, and real estate. Financial activities well above the national average, and that sector has shown strong growth as well. So here's that average hourly wage nominal. This is the number that, kind of gets reported, or at least the year over year, month over month rate of change of this particular number. When you look at this goes back to the end of the gold standard. When you look at the average hourly wage in this nominal sense, it looks great. And I think most people would say that this looks really strong, really good. The problem, again, goes back to what we were talking about here, right, with inflation. If your wage gains are 3.9% like they are right now, but inflation, actual goods and services, the rate of change of goods and services that you need, if real inflation is 5%, you can have a positive number and still be losing money. And again, going back to the way CPI is calculated with all of its substitutions and adjustments and all the kind of manipulation that goes on with the CPI number, some of it warranted, a lot of it not. Look at OER, for example. It really brings into question this nominal average hourly wage number. What good are rising wages if inflation is rising even faster than wages? So, I figured to close here, I'd run through some of those ways to try to estimate that. Here's the average hourly wage in gold. And again, this shows that, in the peak, this matches my silent depression framework that I've talked about at length. But here in the peak, right before China's admission into the World Trade Organization, December 2001, April of 2001 saw the peak of this average hourly wage divided by gold. And what this shows is how many ounces of gold, real, tangible, scarce asset, you get for 1 hour of work on average. We can see that peak was 0.06, meaning you got 0.06 ounces of gold for 1 hour of work on average. We can see that number currently is 0.01 and has been declining relentlessly. Here is the average hourly wage divided by the S&P 500. Again, I've also shown an inverted, might be better to show an inverted version of this. This shows the number of hours you need to work to buy one share of the S&P 500. And that number has been growing, meaning the S&P 500 has been rising faster. Financial assets have been rising much faster than the average hourly wage. We can see this going back to the 80s when financialization started to really kind of grip the American economy. At its low, the average worker would have to work 15 hours to get 1 unit of the S&P 500. And we can see here the kind of dot-com bubble, right? This was, globalization was really starting to take hold. Financialization, not just in America, but in the West. I think America took it to the extreme. We can see this number, got as high as 100. So we went from 15 hours of the average work to buy 1 unit to over 100. And we can see what's happened over the past 10 to 15 years. The bottom here in 2008, the average worker would need to work about 40 hours of 40 hours to get 1 unit of the S&P 500. 40 hours, that's about one full-time week. We can see that number at its peak. This is one of the reasons that I believed the S&P is so overvalued, was so overvalued. This number had reached a peak of 200. Now, clearly, you can't use this as a timing mechanism, but I think this shows the degree to which capital is prioritized over labor in the current American economy. And this really took off after 2008. QE 2 and 3 here in 2012 and 2013. And this shows, too, we will look at in a second, we will look at the net worth of the top 1%, or the average hourly wage compared to the net worth of the top 1%. This data only goes back to 1990. We can see that the average hourly wage has been, put another way, the top 1%, their net worth has been growing much faster than the average hourly wage. So remember, when this line is falling, it means the denominator is growing faster than the numerator. And so another inflation kind of metric to try to determine the real purchasing power of the average wage. Here's the average hourly wage divided by the M2 money supply. This shows, again, if the M2 money supply is growing faster than the average hourly wage is growing, they are both growing, right? We established that looking at the nominal average hourly wage, it is growing. The M2 money supply is growing faster. Meaning, remember, inflation is a monetary phenomenon. If the money supply is growing, you can have positive wage gains. You could even have 5 or 6% year over year wage gains. But if the money supply is growing at 10% per year, you are getting poorer. That wage that you are getting, which looks so great because the line just goes straight, exponentially up, that wage is getting you less and less real goods and services because the money supply is increasing faster than that average hourly wage. So again, I think that going a layer or two deeper under some of these things is really important. The average American has been getting brutalized in terms of the real purchasing power of their wage for a long time now. And I am hopeful or cautiously optimistic that with the right policies, kind of breaking the current system as it's been structured, this kind of hyper financialized, hyper globalized sort of structure. I am hopeful, cautiously optimistic we can see real, actual positive purchasing power increases for the bottom 90%. This has been seen before. The past 50 years or so, we have not seen that clearly. We can see these lines going straight down, especially over the past 10 to 15 years. But it has been seen before in America. You take the mid 60s into the early 80s. This is kind of the last time we had similar populism from a political standpoint. And look, it's not good for financial assets. It wasn't good for them back then. They went sideways in nominal terms. In real terms, they fell significantly. So I think that it is looking like that a repeat, using that framework of the kind of mid 60s into the early 80s, the last populist time period. I think it is useful, and it'll be something that we'll continue to watch. But certainly when we look at the past 50 years, the average American has been getting just absolutely brutalized. Again, if you're in certain industries, you have been doing really well. I saw Ken Griffin is the CEO of Citadel. I saw him talking about this deglobalization and kind of the strong dollar and all the stuff that we've been talking about. Very, very critical. Well, if you're Ken Griffin and you work in finance, you work on Wall Street, you run the largest market making firm in the world, of course, you're not going to want, a weak dollar. You're not going to want to bring high paying manufacturing jobs back to America. You want a kind of ever hollowing out of the country. Because remember, as the trade deficit grows, that means more money, mechanically, structurally speaking, must be recycled into financial assets in America. So as the trade deficit grows, as the current account deficit grows, certain industries like Ken Griffin's in finance and financial services do really, really, really well. And we see that reflected when we look at the average hourly wage relative to the S&P 500, when we look at that average hourly wage growth relative to the growth of the top 1%, who, remember, hold all of their wealth. Most of their wealth is not from income, it is in financial assets. We can see this asset inflation and this bifurcated K-shaped economy. And I think most Americans would agree that economy is not working anymore, hasn't been working for decades, and we need to change it. I think some people differ about how to do it, but I think in general most Americans can admit that the current structure of the system is badly broken, needs to be fixed. So, anyways, hopefully that was helpful. I'll catch you in the next one.